Have you ever wondered why market prices sometimes suddenly leap or drop, seemingly out of nowhere, even when financial models predict smooth movements? This phenomenon poses a significant challenge for traditional options pricing. The Black-Scholes model, while foundational, is fundamentally limited from accurately modeling these sudden market jumps primarily because it assumes that asset prices follow a continuous, smooth path driven by geometric Brownian motion, and that volatility remains constant. The core reason lies in its mathematical framework. Black-Scholes is built upon the assumption of geometric Brownian motion for stock prices. This means price changes are always small and continuous, like tiny, constant nudges, never discrete, sudden leaps. It also assumes volatility, a measure of price fluctuation, remains static over the option's life. This combination forces the model to treat large, abrupt price changes, such as those caused by unexpected news or events, as extremely improbable or impossible, contradicting real-world market behavior. Essentially, the model sees the world as a smooth curve, unable to account for sharp, vertical lines. To address this critical limitation, financial engineers and quantitative analysts have developed more advanced pricing models. These alternatives, like jump diffusion models or stochastic volatility models, relax the strict assumptions of Black-Scholes. They incorporate mechanisms to explicitly account for sudden, discontinuous price movements and allow volatility to change over time, offering a more realistic representation of market dynamics. Real-world market returns often exhibit what quantitative analysts call fat tails or leptokurtosis. This simply means that extreme events, those large, sudden jumps or drops, occur much more frequently than the normal distribution assumed by Black-Scholes would predict. Recognizing this phenomenon is key to understanding why standard models might undervalue out-of-the-money options, which benefit significantly from these larger, less frequent price swings. Ultimately, while the Black-Scholes model remains an indispensable starting point for understanding options valuation, grasping its inherent limitations, especially its inability to capture sudden market jumps, is crucial. This understanding guides practitioners toward more sophisticated models that better reflected the complex and often unpredictable nature of financial markets, enabling more accurate pricing and effective risk management strategies.